welcome to The Trade. Before we get to the charts that matter, let's have a quick look at what traders are watching out there. And Republicans in the US Congress have teed up a new vote for a spending package that would avert a looming government shutdown, this time with the support of President-elect Donald Trump, who scuttled a prior bipartisan version. US third quarter GDP growth revised up to 3.1%. The upbeat report's coming a day after the Fed delivered a third consecutive interest rate cut, but projected only 2 rate reductions in 2025, citing the economy's continued resilience and still elevated inflation. Russian President Vladimir Putin has indicated he's ready to compromise over Ukraine in possible talks with US President-elect Donald Trump on ending the war, and had no conditions for starting talks with the Ukrainian authorities. And Amazon.com workers at 7 US facilities have walked off the job during the holiday shopping rush as workers protest what they say is the retailing giant's unfair treatment of its employees. Getting into the technicals now, Ilya Spivak from Tasty Live joining us. Ilya, good to see you. I mean, we're looking very much at market repricing after we heard from Fed Chair Jay Powell. You're saying essentially a bit of a judo strategy here.
Very good to be here, Juliet. And yes, it's a very interesting thing that the Fed is doing here, because it is, in a sense, leaning into the market's most recent speculative bias, whatever that bias may be. So let's take an example of September. The Fed came out very, very dovish. It said 100 basis points this year, 100 basis points next year. It delivered on half of this year's tally in one go with a 50 basis point rate cut. Of course, by then, the markets were already leading yields down and bonds higher, going all the way back to the middle of the year when the Fed was resistant to cut, but economic data was cooling. And the market was saying you're going to miss the boat and not cut soon enough. But by the time the Fed actually made good and delivered this dovish message in September, you can see it from the chart of 30-year here, that was the top in the bond market, the bottom in yields, the bottom in the US dollar, because by then US economic data was already going the other way. The economy was warming up. And so the market said, oh, well, you're cutting into a warm economy. This is going to be reflation. So higher yields and higher dollar and fewer rate cuts next year. They went into this week's meeting wanting 50 basis points only next year. And the Fed said, okay, here you go. Here's exactly what you're looking for. But of course, at this point, US economic data is cooling again. So maybe what we're looking at here is the Fed managing speculative interest. This is what you would maybe want to do in a soft landing, and not let the markets over speculate and over extrapolate this way or that. So they are letting speculative froth overshoot them, leaning into it and then saying, well, now you trip over your own feet because you've clearly gone too far. And so what may be happening here next is a bit of a bottom in the bond. As we can see here, we're reaching the levels that were an important bottom for sequence here back in May. So if the market suddenly finds that U.S. economic data isn't quite as hot, going to get CP numbers tomorrow as a start, then perhaps it's going to feel itself as having overshot again, and so you get a little bit of a rebound.
And are we seeing that sort of being played out, Ilya, in other assets as well? When you look at currencies, obviously dollar king, but what's euro dollar telling us?
Well, absolutely. So it's the very same story. So just like you had an aggressive move from mid-September through about mid-November, higher in yields, lower in bonds, so too you have a move higher in dollar, because of course the higher yields give it a yield advantage that's expanding. And so you look at what's happened since then, and you have a massive dollar rally here captured against the euro, but it's really happened against all of the major currencies. I just opted for the euro because it's the most liquid dollar counterpart to give us an overall sense of the greenback's general direction. And it's the same story here. We're at the lows from May, and we're stalling here. The Fed brought us into those lows, but didn't overtake them. So once again, if we're looking at a situation where we have Fed judo and the market has overshot again, then there's a correction here. And as yields pull in and bonds come up, the dollar might weaken off this bottom.
Okay, so if that then weakens, how does that play through into other assets, specifically gold, Ilya, which has had a great run of 2024?
Absolutely. And one of the interesting ways that gold was able to achieve this run isn't only, of course, because as we can see here, from about mid-year through September, we had a Fed that was being pushed by market speculation into more easing. And of course, as we just talked about, they delivered, but the market suddenly felt that was too much. And in addition to that, we also had the reserve buying from China. One of the interesting things that we saw is from about April to now, we've learned November, there was a pause, but in November, buying restarted. So in gold, if you have a pullback in yields, you have a pullback in the dollar, that's of course very advantageous for a metal that is necessarily a foil for fiat currency and also yields nothing. So if yields come in, that's relatively supportive in relative terms for gold. But also, if China is again finding the price attractive and is on another buying spree, last time they were buying hand over fist for 18 months straight, if that's what's going to happen here, then in the same vein, there is a bounce. You might be looking back north of the 2,700 figure before long.
Ilya, thank you. As always, have a fabulous holidays as well. We really appreciate your insights. Ilya Spivak there from Tasty Live. That does it for this edition of The Trade. Be sure to join us again next week.